Hello everyone, thanks for checking out my video. All of US 3 major indices clinched a winning week. Dow Jones gained a decent 1.75%, tech-heavy Nasdaq jumped more than 2.5% higher, and more importantly, the broader market index S&P 500 rallied close to 2% to end the 3-week losing streak. To add on, bond yields retreated slightly towards the end of last week, and that is good news for the stock market. Has the recent market pullback ended? Are we in for a nice rally again? Let's cover them all in this video. The stock market staged a dramatic turnaround towards the end of last week. Major indices were weak at the start of the week but rebounded hard from Thursday onwards and are on the way to retest key resistance levels. Reason for the rally was namely because one of the Fed officials, Raphael Bostic, shared that he thinks the Fed can keep its interest rate hike to 25 basis points as they convene again this month, instead of the 50 basis points which some other officials have previously mentioned. Another good news for the US stock market was that the yield for 10-year Treasury note dipped below 4% towards the end of last week. Investors have been eyeing this 4% key level, as at one point in time it ran up above 4%, and as a result stocks retreated. In case you wonder why, to explain in layman terms, Treasury notes are backed by the US government and are generally more stable than stocks in the short term. This lower risk, however, typically translates to lower returns. So when this return increases to say more than 4%, it's almost a natural instinct for many investors to shift their money from the stock market to Treasury notes or bonds. Therefore, one may say that Treasury notes and bonds have inverse relationship with the stock market. Alright, so what's in store for this coming week? Jerome Powell will testify before Congress on Tuesday and Wednesday. Not sure how much impact he will make on the US stock market this time round. This aside, all eyes will likely be on the non-farm payrolls report, which is set to be released on Friday. This report will gather the most attention because if you recall in the last report, US economy added a strong 517,000 non-farm payrolls in one single month. This blowout jobs report caught the market by surprise. Therefore, this upcoming jobs report will give us a sensing and probably some clarity on whether the surge was a temporary blip or an indication that the job market remains hot. Personally, I think there are some nervous anticipation for this crucial piece of data after the various difficult readings last month such as CPI and PCE showing that inflation remains sticky. Just to also highlight, though Bostic said he's open to raising rate by 25 basis points during this month's FOMC meeting, he also mentioned to let the data guide him. His exact verbatim is as follows. If the data continue to come in suggesting the economy is stronger than I had projected, I will adjust my policy trajectory. Therefore, if this month's data reports continue to come in hot, we can expect hawkish tone from him and the other Fed officials. Other key events for March to take note of would be CPI number on 14 March and FOMC meeting on 21st and 22nd March. Moving over to the technical analysis segment, SPY is looking bullish at the moment. That's how fast things change in just 1 week, or even 1 day. I mean, early last week we were still in this weak trend which had dragged on for about 3 weeks. But then on Thursday and Friday, we printed 2 solid green candles. Specifically on Thursday, that was a bullish engulfing candle on the daily chart, which I posted on Momo platform. To add on to this bullishness, SPY actually broke out of the Ichimoku cloud resistance, as well as bounced off the bottom of the Bollinger Band. On top of all this, it also went back above the green dotted uptrend line. That's like what, 3 to 4 bullish signals? Anyway, watch how the market moves on Monday. If there is no sign of weakness in the entire market, SPY could potentially charge towards the gap between 407 to 408. This will be the first level of resistance, which can be further extended to about 410 or 411. Thereafter, the next target is the recent high of 418. When that breaks, then we will have a chance to go towards August 2022's high of 427. Honestly, despite the various bullish signals, I think it is an uphill task for SPY to hit these levels for now. I don't think we will go past August 2022's high that soon, and I think the next CPI number will be quite critical. Okay, as usual, I will also paint the downside story because don't forget we have Powell speaking this week as well as Friday's non-farm payrolls, and both could potentially spoil the rally party. Okay, so firstly, I would like to bring your attention to the MACD. At the moment, it looks like it wants to have a bullish cross. If that happens, great, the bulls will be happy and the earlier bulls thesis could play out. But here's the thing, I noticed 3 occasions of fake out in MACD. Once in May 2022, once in September 2022, and one more time in December 2022. Each time, MACD gave investors hope that it is about to have a bullish cross, and then it went down and the market plummeted. Once again, I would like to emphasize that the current market is very much driven by Fed sentiment and the various economic data. Trend changes overnight, let alone week or weeks. So be nimble and open-minded that both bull and bear thesis could potentially play out. At the end of the day, don't be too fixated about a particular direction, okay? And this is why I always paint 2 scenarios for viewers. Keep an eye on those key levels and key indicators that I have highlighted. Those are signals to show the probability of whether a bear or a bull thesis is playing out. Let us now have a look at Apple's chart. If you recall, last week I mentioned in my video that Apple was sitting at a dangerous spot, which is the 200 moving average. And I also shared that if this level is held, then bulls would target the 23.6 Fibonacci retracement level with an eye set on the gap at 153. And tada, Apple punched through that Fibonacci level and it's marching towards 153 now where the gap is. Similar to SPY, if market opens strong on Monday, then Apple could touch this level, and further strength will send it towards 157. Thereafter, I think Powell and Friday's job report will determine if Apple can charge towards the 160s range. At 160s range, I don't see lots of resistance, maybe a small one at 165-ish. On the downside, let's say last Friday was only a momentum rally because of the Fed officials' comment and weakness resumes this week, then we will very likely feel the gap up that was created on Friday, and that's 146 to 147. To take note, this is also where the 200 moving average is. Again, this area will be a better zone for bulls and bears as 200 moving average is often seen as a critical level for both parties. If this level gets breached, the next bear target would be 144. A stronger support will only come in at around 140 to 141, where the 50 moving average and the next Fibonacci level are. I think it is unlikely we will breach this level before the next CPI number is released on the 14th March, barring any major surprise from the market of course. Moving over to Tesla. Tesla has been range bound for about 21 trading days, which is like the whole of last month. This is definitely good for option sellers. More on that later. When I zoom out of the chart, I notice there is this range about 205 to 210, plus minus a little bit, which Tesla is unable to break above. At the same time, bulls are also defending Tesla quite well as you can see it bounce off this 185 level, a level that I have shared a few times in my video and on Moomoo platform. Alright, now I want to bring your attention to the Bollinger Band. The longer Tesla consolidates within this tight range, the smaller the Bollinger Band will get. Typically, when Bollinger Band gets real tight, it is often followed by a huge move. This has happened in the last few occasions as marked out by this chart. And this is the reason why I have not opened a short-term trade on Tesla last week, as I am waiting for its next direction and hopefully to ride on the trend if possible. So let's say the next movement is on the upside. As per my previous videos, the first immediate resistance remains at 200 moving average, which is around 221. And if the momentum is strong, we can expect Tesla to go above this moving average, retrace to test it and then bounce off to hit towards 237. To me, this 237 level is not a strong resistance level. The stronger one is at around 255 to 262. To clarify, 200 moving average itself is a strong resistance, and that's the immediate obstacle for Tesla bulls. On the other hand, if Tesla's next direction out of the tight Bollinger Band is on the downside, then I feel 185 will not hold. Bear's target will be at least sub 170. And not to scare you, just looking at the technical chart, if the market is weak or we get some shit news from the Fed or economic data, there is little support all the way to where the 50 moving average is at 161. And when that happens, That big gap between 146 to 155 will act as a magnet to try to pull Tesla further down. Moving on to Google, looking good to me at the moment as it flirted with the 90 support level and bounced off it with a bullish engulfing candle on Thursday. It even closed slightly above the 50 moving average on Friday, which is 93.4. So if the bullish momentum continues this week, we could easily charge towards the 100 resistance level. That is where I will consider selling covered call again, probably with strike price near the 200 moving average, which is around 102, or maybe the next resistance level at 105. So anyway, expect Google to face some resistance at these two levels. A breakthrough above this level will see Google attempt to fill the gap at the top again, at around 108 to 109. Bulls actually failed to fill it the last time round we hit this range. So if Google reaches this level again, pay close attention to it. This gap will serve as a resistance, and if Google is unable to break above it, then we could form a double top and Google may start sliding down again. Now for the bear thesis, 90 will continue to act as a support level. It is only when this is breached, then the last support level of about 85 to 87 will come into picture. This range has to hold. If not, there is a high chance we will breach the recent low of 83, which will then potentially open the floodgate to below 80. Okay, since we are talking about Google, let's cover the option trade for Google first. Remember in my last video, I showed you that my Google sell put trade was down about 100%. Currently, it's up 40%, and that's about 140% swing in 1 week. As shared previously, it is normal to see your trades swinging massively in options trading, so do exercise caution if you are trading options. Anyway, as I saw Google was looking bullish in the near term, I actually placed a sell put trade on Friday with 86 resistance level as strike price, but sadly it didn't get filled. I will see if I can get some good premiums early next week if there is any slight pullback. Meanwhile, last Friday, I had a cover call contract on Tesla that expired worthless. This call contract was sold on 27 January, and I am gonna share the reasons why I sold it back then for viewers to understand my thought process. Okay, so it all started with 26 January when Tesla gapped up and jumped close to 11%. Then the next day on 27 January, it went up another 11% and RSI was hitting a very oversold level. When stock had such a parabolic run up, 22% in 2 days, some form of retracement is expected soon. And that was when I saw the opportunity to sell a covered call, which is a slight bearish move. Well, yes, Tesla went on with its rally mode in the next 2 weeks. You know, Tesla being Tesla. But was I concerned? Not really. Because firstly, my strike price was very far out. Just to play safe. And secondly, I knew 200 moving average will pose as a strong resistance. So even if Tesla wants to break above it, it will take time. And by then, my option contract will lose value day by day due to time decay. It will then expire eventually, which happened last week. As a result, I got to keep the $125 premium. Looking ahead, I will wait for the next opportunity to sell another covered call for Tesla. Alright, some quick end thoughts from me. It is evident that the stock market has been sensitive to Fed's comments, inflation numbers, and also bond yields in the last don't know how many months. Every time when there is a change in Fed's sentiment or CPI numbers, the market reacts in a massive fashion, both up and down. If we were to use an analogy here, I would say this whole stock market is like a casino now, and Fed officials are the house and dealers. Our fate is pretty much controlled by the Fed's narrative, aka the cards they deal us. And 9 out of 10 times we, the retail investors, walk out of the casino losing money. Okay, specifically for this month, if the various data points and economic reports continue to show that the labour market remains resilient and inflation is still hot, thus supporting Fed's tightening policy, the market could remain weak for this entire month, just like what happened in February, where almost major indices were in the red. Personally, I am of the view that the market is unlikely to have sustained rallies until data points show a resumption in cooling trend for inflation. And sadly, at this point, it seems like the market is completely ignoring companies' fundamentals. That being said, this is only for the short term, which could easily range from a few months to maybe 1 to 2 years. Again, as a long-term investors of about 5 to 10 years or even more, pullbacks in the stock market are always buying opportunities in my opinion. I myself have been picking up shares along the way whenever there is a pullback, and stocks fall to my target price. Lastly, a friendly reminder on not to rush to boost your exposure based on last week's rally, because under the current climate, any market rally could easily fatal, and you wouldn't want to use up all your cash by purchasing stocks at high prices. But at the same time, you also wouldn't want to keep all your cash by the sidelines for too long, because when the market starts its new bull run, which you may not be able to predict when, a lot of late money will start pouring to the market. You wouldn't want to be part of this FOMO crowd, as you would be buying stocks at high prices and missed out on stocks at discounted prices, which is like now. So yep, I hope you got the drift. It's all about striking a balance. Alright, that's all for this video. What are your thoughts on the current rally? Do comment down below, and please help this channel out by tapping the like and subscribe buttons. Thank you.